Welcome to the Real Money Coach. I am your host, Tony Jackson, coming to you from Charlotte, North Carolina, the Queen City here in North Carolina. Last week at this time, y'all, I was in Mississippi. We're coming to you live from Mississippi, but I'm back home now. I do want to just share with you all just what a wonderful experience I had visiting Mississippi. Got a chance to do a little thing there in Jackson, Mississippi on Sunday, and then we spent 4 days doing a kids camp for two different cities in Mississippi. And I tell you what, it was an amazing experience. Matter of fact, we're going to have one of those directors on the show. I don't know if it's going to be next week or the following week, but we're going to have her on, Dr. Martha Liddell from West Point, Mississippi. But let me tell you kind of what we did with these camps, right? And first of all, y'all know what to do in the chat box, right? Put where you're watching from. Where are you watching from? What city you watching from? So this is how Marlon Smith and I did the kids camp. So we started out with really just kind of doing some icebreaker exercises with them on day one. And then part of day one is they did their vision boards, which was very, very interesting how they were doing their vision boards, because we do know that where there's no vision, the people perish. Renee, thank you for being here all the way from Connecticut. And so we're doing these vision. Kimberly, thank you for being here. So we're doing the vision board. So, the kids are putting the vision boards. They got cars, they got houses, football, sports, modeling, the superstars, Beyonce, all these type of things. And so we had them make these wonderful vision boards, come up, share their vision boards. And then what we had them do is we asked this question. Now that you've done this vision board and you have all these wonderful things on here, how are you going to pay for it? How are you going to pay for it? And that got us into a discussion where we're talking about careers, STEM careers, those type of things. And then we could get into some other things like, what is a budget? What is income? What is expenses? What is savings? And so that was a really, really great exercise to teach these kids that. And it's just to watch them soak it in and all that. And then day two, we came back, and kind of the highlights of day two is we then taught them a little bit about what is an asset and what is a liability, what is credit, what is loans, all these types of things that we as many adults don't get to spend much time doing. And then we wrapped it up with a tournament of cash flow for kids. And it's very interesting, this game, Cash Flow for Kids. I was at Cash Flow for Kids. So we played Cash Flow for Kids, where they got a chance to put into action some of the things that we were teaching them, through the other exercises and that type of thing. And I tell you all, I'm just sharing this with you because it was very, very rewarding, just to be planting these seeds of financial literacy in these young people. They were K through 5, right? So we had kindergarten through 5th grade, and then we had some, middle schoolers that were our helpers and that type of thing. And so one of the things I do want to do is say hats off to all of my teachers out there. If you're a teacher out there, put it in the chat box. If you work in education in any form, I don't care, any form, if you're in education, I do want to give a big shout out to you because it wasn't easy, right? And our teachers, our educators, our TAs, I know they don't call them TAs anymore, but our directors at child care facilities and schools and magnet schools and private schools, all these things are spending all this time with our kids teaching them. And, in my opinion, they don't get paid enough for what they do. But nonetheless, I know it's rewarding, and most of them don't do it for the money. Listen, while I'm here, I do want to remind you, as you see it scroll across the screen, please subscribe to our YouTube channel. Go to our YouTube channel, subscribe there. Also join our private Facebook group. Join our private Facebook group. I think that's important, that we continue to communicate. There's a couple things I want to announce that is coming up. At last, we're here. Our first show on iHeart, or not. I keep saying iHeart, y'all. Y'all gotta help me out. On Radio One, Praise Charlotte, Praise 100.9 here in Charlotte, will take place this Saturday morning at 7:30 a.m. This Saturday morning at 7:30 a.m. Thank you, Alice, for being here. And so, really, what we're going to be doing with that show on Saturday morning is, number one, we'll just be sharing some financial education, financial information, like we do. I don't know. We might spend some time going through the book. Who knows? And then we're going to have a guest speaker that will come on, a guest that will be a guest interview on the radio show. Now, again, this airs on Saturday. And the plan is that whoever's going to be the guest on Tuesday night is going to be who we're going to be interviewing for Saturday. So Saturday is going to be a lesson, right? A lesson in some fashion or form. We're going to have real money news, right? So that's going to be news as it relates to money. We'll have our guest interview. And then we'll have what I call real money moves, which is our education component to that. And then that interview, that person who's going to be there for the interview will then be our guest on Tuesday. And so on Tuesday evening, that person will be our guest. So we're going to give you a little taste of it on Saturday, tell you what you can expect on Tuesday. And then on Tuesday evening at this regular time, 8 p.m. Eastern time, we will have our Facebook Live. And just to let you all know, you can go back to Facebook, you can go to YouTube and rewatch these. As a matter of fact, it's even on Patreon and Roku as well through our relationship with Every.Black. So that is kicking off this Saturday, the first show at 7:30 a.m. Praise 100.9 if you're here in Charlotte. And you can go to praisecharlotte.com if you're in another location and be able to catch that first show. Now, what else is going on? We got the PNC conference coming up in August, first weekend in August. It will be PNC in Houston, Texas. Be the first time it's been a live event in quite a while. And so we're looking forward to being there and being a part of that for one day, because after that one day, I will be heading back to Charlotte so that we can get to my son's wedding. You guys have met TJ. He's been here for the last 4 weeks co-hosting with me. Michelle Mitchell, y'all favorite Michelle, will be back next Tuesday evening for our show. So a lot of great things going on, and just really kind of excited about it. One of the things, if you want to plug in on, and we'll have a graphic on this next Tuesday, but we on the 14th of July, we will be doing a webinar on Thursday evening at 8 p.m. And it is Wealthy or Broke, How Will You Retire? So we'll be doing that webinar at 8 p.m. on July 14th in conjunction, in partnership with the Black Couples Getaway. So I think that's all my announcements I have. Listen, I'm flying solo tonight, y'all. But one of the things I wanted to talk about this evening, and it came up while we're in Mississippi, is this stock market. And as many of you know, oh, the other thing, let me just say, I know I get some comments in the chat about this. Yesterday was my wife's birthday, but on the 25th of this month, we'll be celebrating 30 years of marriage. And so that's coming up. I won't be online that day. I won't be online that week. Be celebrating my anniversary. So, and so that's coming up. But this came up about the stock market. And many of you were there for the first show. I mean, I think Alice Martin may have been part of that first show on April 2nd, 2020. And I want to have Dante bring up a graph from April 1st, 2020. This is why we did it. Not that one. That's there we go. There we go. So this is April 1st, 2020. And as you can see, all of the stock market indices were down. Dow Jones was down. Dow Jones is your 35 largest publicly traded companies, right? The 35 largest U.S. companies. The NASDAQ, which is a big mutual fund market. The S&P 500 was down, which is your 500 largest publicly traded companies. Apple was down. Google was down. And so we had all these major companies, and we were dealing, thank you, Renee. And so we're dealing with this market conditions. And as a result of that, we said, now we need to get some information out to let people know that they're okay. And so then if we bring that graphic up for today, or not today, but a few days ago, we're seeing here, this is July 1st. Here we are 2 years later. Not only are we still dealing with this whole thing of Corona and the virus and all this and all the mask and all that, but look, it's very similar to what we were dealing with before. Markets down, Dow Jones down, NASDAQ down, S&P 500, Apple, Google, same scenario. Now, there's been a lot of opportunity in all of this, but my point is that we're still dealing with the same issues. And so often when we're talking to people, we're talking about how this is like a clock that keeps repeating itself. And so there's certain ways that certain things that we can do to protect ourselves from those market crashes and those downturns in the market. And so what I want to do this evening is, as I looked at that, and I happened to look back, in 2020, and I'm saying we're dealing with the same thing. So if you've ever heard of Throwback Thursday, well, we're going to give you Throwback Thursday, the Tuesday edition. So what we're going to do now is we're actually going to go back and we're going to replay a recap of that very first show. Now, the very first show was long, y'all. I mean, I think it went almost 2 hours. And so what we have is we have a 30-minute recap. And it's just so, to me, it's just so amazing how the same things we were dealing with then, we're dealing with now. And guess what? We still have a solution for you. We still have a solution for you if you want to be in a position where you get the upside of the market without the downside gain. So what you're going to see is you're going to see a recap of that very first show from April 2nd. I think this recap was put together maybe a month later. And it's going to have Marlon, myself. We're going to have a gentleman named Michael Harding there that was explaining how the indexing strategy works and how it can work for you. So we're going to roll that, and then we're going to come back, take any of your questions that you have, and wrap up the show. So Dante, we got that queued up, ready to roll? There it is.
My name is Marlon Smith. Very grateful to be here. I invited some industry experts to share what's going on. Again, this is entitled COVID-19, the stock market, Wall Street, and your money. Okay, how do I move through this? How do I, grow through this? There's a lot going on. There's a lot of different information out there. So I wanted to bring on a gentleman who's really passionate about making a difference. And this is a man who I truly trust, somebody I respect, a man who's had 23 years of experience in financial services, and not just experience, but success in financial services. And so what's so amazing about this gentleman is he's been married 27 years. He'll be celebrating 28 years this year. He's got 4 kids and 3 grandchildren. And so when I'm about to bring him up, you're gonna be like, he is too young to have some grandchildren and to be married 28 years. What? That's amazing. So here's what I'd like for you to do. Would you please put your hands together, get ready for my brother from another, Mr. Dr. Reverend Tony Jackson. Come on up.
Hey, Marlon. I was wondering who you were talking about there for a minute, man.
I know.
Good. Yeah.
It is. And look, Tony, we're so excited to have you, man, because look, people are already posting questions. You know, someone says, do you recommend buying stocks now? If so, how does one buy? You know, interested in learning how to invest. So again, this is great because again, we're talking about resources.
And so what we're going to talk about really tonight is the economic impact of all that. And, you know, what was popped up in the Washington Post, they ran this ad. In the Washington Post, it says, the downturn exposes the reality of the U.S. economy, and that it was never really as strong as it seemed. And when we look at this dollar here, we see that it's fragmented. And what we found out is that our economy has been fragmented. There's some people who have done very well. There's some people who were doing okay. There's some people that were just really kind of surviving. And when you have a situation like we have now, what it does, it really exposes those fragments. And now, how do we pull this all together? How do we unite in one front? And how do we get information out that can really help people? The CARES Act was just signed into law just last week. And really, it has really 6 components to the CARES Act. The first is the financial assistance for companies in need. And that's really, we're talking about your major companies, your big companies, big business, states, municipalities, cities, governments, those types of things. And then there's economic support for small businesses. And that's really, we really encourage you to seek out some of those things. And perhaps even next week, we could come back in and really highlight, really hone in on some of those things. But definitely, you want to reach out. We have some resources for you. If you email us at info@therealmoneycoach, we can get some of those resources to you, get some of those links to you, where maybe you can take advantage of some of those things in terms of the small business, economic support, small business, freelancers, independent contractors, those types of things. So now let's look at it in terms of in retirement specifically. There's really some key points that I want to pull out. And number one is right now, there's also an opportunity, and the opportunity is there where if you have a 401k or you have a retirement account, you can now get up to $100,000 and not pay the 10% penalty. So what happens is if you pull money out of your retirement account prior to being 59 and a half, you're going to pay ordinary taxes, and you're also going to pay a 10% penalty. Well, as part of the CARES Act, what they're doing is they're eliminating the 10% penalty up to $100,000. And so you can pull $100,000 out of your qualified retirement plan and not pay the penalty. Now, if you are currently working and you have a 401k or 457 plan, it's really up to your employer and the plan administrator how they want to administer that. But most of the time, that's going to be done as a loan. But also part of the CARES Act, it allows you to, instead of doing the max loan, which was $50,000, it now allows you to go up to $100,000 if you're going to borrow out of your 401k, 457 plan, retirement plan, those types of things. Now, the other interesting part of that is that when that occurs, it does not avoid the taxes. So you still have to report that money as far as ordinary income for your tax return. But the law does allow you to stretch out that tax liability over 3 years. So in essence, if you're a 22% tax bracket, you pull that money out, that $22,000 of taxes, you have over 3 years to actually pay for that. Now, so again, I think that's something that we really could drill down on maybe next week, talking about the tax implications of that, possibly talking about if this is a great time to do a rollover, because right now we have 2 really great things going on. Is you have taxes being low, and they're really low compared to what we've been
you avoid the tax penalty, and the fact that now if you roll out, you're buying at a low price because of the stock market. And so it's really a great time to maybe make some of those type of moves, converting to a Roth IRA, or maybe looking at some other tax-free retirement vehicles. Now, also as part of the CARES Act in terms of the effect on retirement is the RMDs, the required minimum distribution. If you are 72 or older for the year of 2020, you do not have to take your RMDs. You do not have to take your RMDs. And so that could help a lot of people in terms of not having to pull that money and use it, paying taxes on it, and that type of thing. So there's some really good things in this act. Of course, the stimulus, of course, the help for small businesses, and also being able to access up to $100,000 of your qualified retirement money. So now it's a great time if you're in a position to take advantage of some of those things. So make sure, you reach out to someone, us or someone that you're working with, to look and see if any of those moves make sense for you, depending on where you are, how long you have to retire, and all those type of things. But they really have loosened up some of the rules to allow people to get access to their money because of the current economic situation.
When it comes down to it, $2 trillion. I mean, just let that sink in, y'all. Okay, $2 trillion, because just in the United States. I mean, I'm not talking about other countries. And so the stimulus package. I mean, what happened, Tony? Why? What's going on? Talk to me, bro.
Yeah, how do we get here, right? What is this necessary? Well, really, when we look at our economy and we look at the stock market in particular, there's really two very main indices that we really take a look at, and those are the Dow Jones and the NASDAQ. Now, the Dow Jones, a lot of people don't realize that it's the most common indice that we look at. It's one of the biggest economic indicators, not only for the United States, but worldwide. And it's really only 30 companies that make up that Dow Jones index. And what you see on your screen right now is really a 3-month graph. And if we look at this closely, what we realize is that the 52-week high was just over 29,000, and where the market closed at yesterday was just under 21,000. And so from the high point that we had within the last year to where we were at the close of the market yesterday, we're down 29%. And again, this is a major indicator of the strength of what's going on in the economy. And we think about the Dow Jones has been around since 1860s, right? And it is the 30 largest publicly traded companies. Today we think about companies like Apple, Boeing, and Coca-Cola, Goldman Sachs, IBM, Microsoft, Nike, all those very big companies. The 30 largest companies make up the Dow Jones. But as they go, so goes the economy. But again, because we're riding high on gains over the past years, a lot of people really want to learn about it. But when you look at these and you look at the last 3 months of what's been going on, there certainly is an issue here.
Wow, thank you, Tony. People are, man, the thing is just blowing up, man. People are commenting and so I want you right now to type in the chat box, what are you feeling? You just saw, the Dow Jones, NASDAQ, S&P 500. What's one word you're feeling after what Tony just shared? Just type it in the chat box just so that, we just want to see some of the words, some of the emotions that you're feeling, the feelings. And again, there's no judgment, but I mean, look, I'll say I'm depressed, right? I mean, I just saw, you're talking 27, 29, 24% decrease. I mean, we have somebody that said, Sunchen said, how do you rebound after you've taken such a hit?
Let's talk about it from a historical standpoint.
Okay.
I want to talk about it from a historical standpoint because the charts that I just showed were really the last 3 months. And, the thing about it, they say you have to learn from your history or you're bound to repeat it, right? And so what I want to do is just really show this chart here from a historical perspective. And if we look at it closely, this is going from 1998 through 2019. Okay, so we're talking about a 20-year period of time. And as we know, in the early 2000, the market was falling. You know, you talk about that tech bubble. And here's the thing that's really pretty alarming about that is that it really took 24 months for us to hit the bottom. And so at the bottom of the 24 months, we were at 29%. We're already at 29% today, or as of yesterday, we were already at 29% of the Dow Jones. This happens to be the S&P 500, where we're 27% down as of yesterday. But in the early 2000s, it took 24 months before we got that low. And so this fall that we're experiencing is even steeper. Now, what's even more important is how long did it take to come out of it? And in this example that we're looking at, tracking the S&P 500, it actually took 8 years to get back to where it was when it started to decline. So it took 8 years. So we get to 2007 going into 2008. And if you were perfect in your timing, you put money in 1998 and you were perfect in your timing. We understand you can't time the market, but if you were perfect in your timing, you would have pulled out in 2008 before it crashed. But most of us don't know that. We can't time it that perfectly. So you see it peaked at the end of 2007, 2008, and then it fell again to 38% under where it was. And that happened in a matter of 12 months, 38%. And so now, you know, I came through the early 2000s. It took me 8 years to get back to where I was. And then overnight, the real estate bubble burst, right? The mortgage bubble bust, right? And so now I lost 38% in a matter of 12 months. And then it took 5 years to get back to where I was. And so when we look at that in totality, in essence, you know, if it would have taken us really 13 years to get back to where we were. And the other thing that we can't time is not just the market, but we can't time life. So what I mean by that, and if we haven't known it before now, is that we're mortal, right? We're mortal beings. Sure. And, you know, if you happen to pass, God calls you home at the bottom end of one of those downfalls, I mean, what does that mean? Or what does it mean if your retirement comes at the bottom of one of those? And all those types of things. But there's a lot of variables to look at. Don't be alarmed, but just be informed and talk to someone that can help.
You know, I love that, Tony, because yes, success leaves footprints, right? And what Tony's really saying is that, you know, I believe is you focus on what you do the best and you let others do the rest. And so with that, Tony, you know, there are some individuals that have hedged themselves from downside loss and they are rocking and rolling. And so let me ask you, I mean, what's a strategy? You've been in the financial services industry 23 years. You know, who are you modeling? What are you doing, right? You know, to, you know, not feel this pain that so many people have identified, you know, in this chat.
Well, what I want to do is show you the most quoted man in investing, right? We all know him as Warren Buffett. Warren Buffett says this. He says the number one rule in money is to never lose money. And the number two rule is never forget rule number one. Now, Warren Buffett coming into 2020 at $128 billion in cash. Okay, so he knows a little bit about money, right? And so how do we take this concept and make it live for people that we deal with every day? And how we do that is a concept we call indexing, fixed indexing, the power of indexing. And so now what you have on your screen is you have that same red line, same period of time from 1998 through 2019. Now the blue line is using the indexing concept. And we're going to actually bring on an expert who's going to explain exactly how the indexing works. But I'm just giving you an overview and letting you see right here what happens with the indexing in a real basic description is when the market goes up, you make money, but when the market goes down, you just move sideways. So you never lose your principal. You always keep your gains from the previous year, and then it just continues to move up. And so when we look at this, we're following the blue line. The market is going up in before 2000, but then the 3 down years of the 2000, those 24 months, you stayed exactly the same, right? And then when the market starts to go back up, you get to 2008 again. You've recovered. You're actually doing better than the market because you don't have to dig out of the hole. But then the market crashes in 2008. What happens? You stay the same. Now the market starts to go up again, and now your account goes up again. And so this just shows us, and you can see there's points in time where the gap between the blue line and the red line is pretty tremendous. And so that's a lot of ground to make up. And because the market has done so well, going, from, coming out of 2008 and getting into 2013 and beyond, a lot of people forget that that could happen again. And so, but this ends in 2019. But that's the concept that we believe is important for the important money. If the money is not important, then, maybe this doesn't matter to you. But if the money is important, meaning that it's money that you have set aside for your retirement, or maybe it is money that you have set aside to leave as inheritance, or whatever the case may be, it may be a concept that you might want to consider for some of your money.
I want to bring up our next guest, a lady who's really on a mission. And I just love the energy of this lady. If you think I'm passionate and I'm optimistic, right? You're going to really love this young lady, because this lady is on a mission, and her company, JP Financial, is really doing some great things. JP Financial Group. Her name is Joyce Palmer, and she basically started her company in 2009. She's the managing partner of this financial services movement. Really, I love to say it, because she's got a team of committed advisors, wealth advisors, coaches, and so on and so forth. And so, yeah, Joyce, we're glad to have you on. How are you doing, Joyce?
I am doing great, Marlon. Thank you.
Success leaves footprints. So you want to model people that have been successful. That's why when Tony, brought up Warren Buffett, they asked him, what's the number one rule to investing, Warren? He said, rule number 1, don't lose your money. They said, oh, okay. Well, what's rule number 2? He said, see rule number 1. So the next gentleman I'm going to bring up is a man who's on a mission, just really has a big heart, wants to serve the world, because he understands that for too long, it's really been those in the inside circle that get the information, and they're the ones taking action. When other people, have, strong work ethics, striving for their family, just don't have the right vehicle to get them where they want to go. And so this next gentleman is the national sales manager for a company called Anaco. And it's really phenomenal. His name is Michael Harden. And I'm very excited because he's going to really unpack for us, how does indexing work? How does it work? You remember the red line, blue line? The stock market was going up and down, and the blue was going up. And then when the stock market went down, it would just level off. So we're going to learn a little bit more about that. Welcome, Michael. How are you doing?
Hey, Marlon, I'm doing great. Yeah. What makes us so phenomenal? And folks, again, Marlon, thanks for having me on tonight. Tony, thank you for having me on. Everyone, thanks for taking time to be here. These are crazy times that we are living in. And if you'd ever told me that when I got in this business that I would have lived through the .com crash, the mortgage crash, and now the coronavirus crash, I would have told you were crazy, because the market in this period of time has never done what we've seen. Right there it is. So when you see that blue line, here's something that Tony didn't tell you. If you did the math on the loss right now, if you look at his value of that orange line of 262,812 and do the math on that right now, the roughly, and I did 30% as I was sitting here listening to Tony and Marlon. If you do a 30% loss, which is roughly where we are, that person on that orange line has lost almost $79,000. They are now at a level that puts them back somewhere in 2015. They have lost 5 years of their investment life. And if they had had the blue line, they would still have their $262,000. Now, 268, sorry, the one as short as $6,000. So how does that work? Right. So let me talk to you about how this works. Right. These products that are index products are fixed products. They're not investments. You never, ever risk 1 penny of your money. What we do with these products is we use the performance of the S&P 500 index to determine the interest rate you earn on your money. Now, how does that work? So let me take you through it kind of step by step. Right. So whenever you make, and I may say the word investment with this, but this is not an investment. Right. So anytime you make a deposit in one of these index accounts, right, you can choose. You can choose one of two ways of earning interest on your money. You can choose that fixed account that you see on the screen. And currently that fixed account's paying a 4% interest rate. So I'm just turning it into dollars. I'm just turning it into $4,000 to make the discussion easy. So you could check that box and tell us you want us to pay you that amount of interest in the next 12 months. If you check the indexing box, the one that says annual point to point, if you check that box, now what you told us is that I don't want the interest. I want the opportunity for the stock market to determine my interest rate. I want the opportunity to make more. And when you do that, we take the $4,000 that we would have given to you, we take that out to the stock market and we buy options on the S&P 500. Now, if you're sitting here and you're an everyday person like I am, you should be asking, okay, how does that work? What's an option? Why do I want to be involved in that? Well, let me show you that. Right. So when we go out to an option is a security that tracks the stock market. Right? That S&P 500 option is a security that makes money when the market goes up. Right? So let's do this scenario. Let's assume that last November, right, you made a deposit into your account. And we're going to lock in on the S&P 500. We're going to take that $4,000 out to the market and we're going to buy that option. Right? Now, 1 year later, we track it for an entire year. You don't make money every day. You don't make money every month. We don't care what happens in between. We're going to watch it from November 1st of 2019 to November 1st of 2020. That's the only day that matters. Right? And if the market is up, if the S&P 500 is up, we, American National, we sell that option because it's in the money. That's in bold black there for you to understand. It's called in the money. We take that, we sell it, and we give you the interest that is earned on that option. Now, if the market is down, then that option expires worthless. It's only worth money if the market's up. Now, here's how it works why nobody loses money. Nobody loses money, especially American National and especially you, because we didn't take your principal, we didn't take the money you deposited into the account, we didn't take that and do anything with it. That money is still sitting back at American National. It's sitting in our general account. It's as safe as the day is long, so to speak. Right? What we took is the interest we would have paid you. You said, I don't want it, right? And so when that happens, then that expires, like I said, that expires worthless. But did we lose any money? American National would have paid you interest. You said, I don't want it. let's go try to make more. If we make more, fantastic. If we don't, then you didn't lose money. You just made zero interest for that year. You see it on the graph. Let's take a look of how it actually works in practical application. We've got a slide next that will show you some of the indexing options. Bring that up there full screen, right? There we go. Awesome. Thanks. Now, if you look at the third column in, it says the S&P 500 return. And what this is the returns over the last 20 years. This counts all the losses and all the negatives in the S&P 500. If you look at that and track that all the way to the bottom, you're going to see over the last 20 years, the S&P 500 on an annual basis, on a calendar year basis, has averaged 4.02%. Interest rates have done that almost, right, with what we're doing. Now, as you look across that, let's just, and not to get into any one of them, but let's just take a look at the math on this. If you've got the 24% multiplier over that same 20-year period, it averaged 8. If you've got the strategy with the cap, it averaged 643. If you have the strategy with the uncapped, it averaged 693. And that's not fair to that one, because this past year, it did 24%. When the markets do great, look at the big numbers in that strategy. 21%, 18%, 24%, right? When the market does big numbers, that strategy captures the big number and it multiplies it on your money. And we spend money, we don't spend percentage. And then if you look at the very end, that strategy over the last 20 years has averaged 10.24%. Look at those. Now, the next slide that I have, just want you to see it in philosophy, right? Tony touched on this earlier. He showed you the downs and he showed you the ups in the markets and some of those things. Look at this. This is what the S&P, these are the bull markets for the S&P, starting back, starting in 1950, coming through 2016. What if, can you imagine what your totals, what your portfolios would look like if you eliminated all the red on this slide? What if all your account ever saw was either 0 right through the middle of that or green? Think about how much more money that you would have in your account if you eliminate the losses. If we listened to Warren Buffett and followed his #1 rule, never lose money, how much would you have? All right, so here's what we need to do today, folks. All right, today you've got an opportunity of a lifetime in this, right? If you believe in the U.S. economy, you believe in the U.S. Markets and so forth, right? Right now is the time for you to get in this at these low levels of what the markets are doing and be poised to capture that market upside with zero potential for loss. Zero potential for loss. That's what we need to do. That's what we need to do now with where you are.
Mute myself. Awesome. So, all of that is so pertinent even today. And again, as we were looking at all of that and seeing this presentation from 2 years ago, people, from 2 years ago, take out the part about the stimulus and the COVID, and it's the same conversation, and we still have the same solution. And one of the things I did want to mention, we were talking about rollover opportunities. They're still there. They're still there to protect ourselves from the market, because even if you got in last year and the market continued to be negative, right? So we're negative again. You wouldn't be going any lower. You would have stopped right there, and you only have the upside to go. And so that's why it's so important. So one of the things it did mention too was the one stimulus package at that time. There was one stimulus package, $2 trillion. Well, since that stimulus package, there were 3 more stimulus packages to the tune of all of them being about $8 trillion. And one of the concepts that we have to understand is that when we see inflation doing what it's doing, interest rates and all this, it's not accident, right? There's this process called quantitative easement. And what that means is they printed money, and they printed money with no gold to back it, no oil to back it, or any of that. So they printed money. That's how they got these stimulus monies in our hands, and this money into circulation into the economy. Well, if you don't have anything to back that up, you then eventually have to figure out a way to pull that back. And that's what we're experiencing now is we have the US government has to slow the economy down. And how do you do that? By raising interest rates, by creating inflation. So you slow the economy down so that you can burn that money that you printed and put into circulation, because there's not enough things to back it up. And so the fact that we're having this double-digit inflation, gas prices, it's no surprise, because it's by design so that we can get that money back out of circulation. The government can get it back out. So those are important things for us to be mindful of. And again, I just want to make this offer to everyone, because I talk about a lot of this in the book in some detail. And the book, of course, is Increase, Protect, and Dominate Your Money. Listen, if you go to ipadyourmoney.com, you can claim your book right there. You can claim it for free by putting in I'm trying to do the other side. By putting in iPad 100. That's IPAD, all caps, 100. And the book is yours for absolutely free. Absolutely free. iPad, all caps, 100. When you put that in at checkout, the book is yours for free. It will take shipping. It'll take it down to zero. When you check out, apply iPad 100, the book is yours for free. The second thing, that if you have not had an appointment with me, if you're sitting on money, sitting in a CD, or you're have money that's in the market in a 401k or 403b or something like that, you need to schedule an appointment with me so that we can talk about it. Now, I'm going to share some solutions with you if I have some that make sense for you, and then you have to make up a decision of what you want to do. And so again, you can schedule an appointment with you right there at that same website, ipadyourmoney.com. Because if you go into the second page of the website,
when I was a student, I'd write long essays that I'd work on for days. But now,
so you can do that, or you can simply go to ipadappointment.com. ipadappointment.com. Schedule your free appointment with me. If you're listening tonight and you schedule, I'll also give you a Amazon gift card for scheduling if it's your first time appointment with me. So let's have a conversation. Let's protect you from what we're seeing going on in the market, and get your free book, and let's go out and make ourselves put ourselves in a better position. And so that's what we have for you tonight. I wanted to have that little throwback. Again, as I was looking at what's going on with the market, look at what we talked about 2 years ago. Same, nothing's really changed. It's just being recycled. So how long are you going to play Russian roulette with your money versus protecting it? And so that's what I do. And so I'm glad you're here. Andre, thank you for your active in the chat, and everybody else for tuning in and staying and watching. And if you're even watching this on the replay, that offer for the book is still there, and also for the appointment if it's a first-time appointment with me. So with that, Dante, take us out. You all have a wonderful, safe evening, and we'll see you next week. Remember, iHeart Radio 1, Praise 100, Praise 100, PraiseCharlotte.com this Saturday, 7:30 a.m. I'm your real money coach. Y'all have a great evening.